Gold, silver, and platinum prices took us on a wild and bumpy ride where we experienced huge price swings. While gold, silver, and platinum ended in positive territory, prices were not anywhere close to expectations. So where do we go from here? Well, think back to the beginning of 2022. Do you remember all the price predictions and forecasts? Well, there's something about the start of the year and the optimism of the new year that makes everyone feel like they're the next Nostradamus predicting the future. Unfortunately, a year later, most of us come to realize that they are much closer to being Johnny Carson as Karnak the Magnificent than Nostradamus.
Short stack. Name the host of Unsolved Midget Mysteries.
Hey, don't get mad at me for the off-color joke. It was the early 90s, folks, and we had different standards for jokes. How about we get to the point before the cancel culture police come and get me? How in the world on God's green earth did orange juice outperform all investments last year? Yeah, with a return of 46%, which was 3% higher than heating oil. And here's the crazy part. Orange juice has been outperforming for the last few years. Okay, so you mean to tell me that to be successful in the 2020s, all I needed to do was follow the playbook from Dan Aykroyd and Eddie Murphy in 1983 from the movie Trading Places? You got to be kidding me. Obviously, the point of this video is not to advocate that we trade our stacks for orange juice futures as we start the new year. I do believe it's important that we pause to take a quick look at how a wide variety of investments performed. Let's start with the negative and move to the positive. As you scan this list, the most surprising return for me is lumber and the 30-year bond. I mean, I knew they performed poorly. I just didn't know it was this poorly. Now, for the positive returns. But I want you to slide down to number 12 and see platinum coming in with a 12% return. As you can see on this chart, highlighted in yellow, this is where I officially changed my position on platinum. And this is when I did my first video on platinum and made a case that we should maybe consider some platinum in our stacks. My biggest rationale was it was really close to production costs and all the fundamentals. To me, that meant much of the downside had been worked out of the purchase price. I have plans for another platinum video that I keep saying I'm going to put out, but I promise I'll try to get that out this month because I still think platinum looks very attractive, but I do think it needs a strong SWOT analysis if you haven't jumped in yet. Moving further down the list, we see what we all know. Silver with a slight gain of 3% and gold basically flat. This is where I want us to focus because I can't believe there's a soul on this earth that would have predicted that good old orange juice would have outperformed the market. I mean, who would have turned down a bet that gold and silver would outperform orange juice in 2022? Now that we are in 2023, I want to offer you 3 key takeaways. 1, put 2022's performance in your rearview mirror. That doesn't mean you forget it or you totally ignore it. It's important to remember the past performance. It's important to remember that past performance doesn't guarantee future performance. I want you to treat the previous performance like the rearview mirror in a car. There's a reason why you have a huge windshield and a tiny mirror that lets you see behind you. As the driver or as the investor, you have to be forward looking while still being able to see what you've passed or what's behind you. Ironically, even though those rear view and side view mirrors are tiny in size, they still offer a huge field of vision. As an investor, you need access to see what's behind you while still moving forward. Here's the second take. If you're a speculator, monitor these investments that perform the worst, as they have the potential to quickly become unloved assets in the future. Those unloved assets can present opportunities where if you have the right time frame, they can become something you buy for pennies on the dollar that you know to be worth dollars in the future. Let me give you an example. Copper is down 14%, but all the research and experts tell us that we're going to need base metals like copper for the green and hydrogen movements. Not to mention, when housing picks up, copper is highly utilized in electrical and plumbing. Also, there's a lot of developing technology where copper is actually being coated with metals like silver as an alternative to using all silver. So if you believe the data and the reports, it seems to me that copper has to increase in price due to the demand. So why not start investing in copper miners now, even if it's 5 years away? That only means I have that much longer to slowly build my position. Again, this isn't advice, it's just what I'm doing. In fact, if you're on Discord, I posted the copper miner as well as a number of other mining stocks I'm positioned in. That may just make going over to Discord worth your while if you just want to see a partial list there. And while I'm talking about the Discord channel, I would like to ask you to do me a favor. If you could, please hit the like button if you're learning anything, if you're enjoying this, if you're getting anything out of it, or if you just want to support the channel. I really do appreciate that. Also, while I have your attention, I also wanted to give a huge heartfelt thank you to Dom for this beautiful compass sundial gift that you sent me. Brother, it is absolutely beautiful. And I'm just moved by your generosity and the beauty of it, of course. And I do take this serious, that my responsibility to be the navigator for folks here on this channel and to make sure I'm always heading us in the right direction. So I take that very seriously and I appreciate this gift. With that, number 3, focus on the conditions, not the predictions. If I've said that once, I've said that 1,000 times. You have to ignore the noise, the jibber jabber, the talking heads on YouTube, which may include me. Instead, focus on the fundamental drivers for your investment or your investing thesis. It's the environmental factors and fundamentals that drive the market. As long as those are in favor, then you stick to your game plan. So as a quick reminder, these are the fundamental drivers of metals and what we should be focused on this year, and ignoring the predictions, but focusing on the conditions so that we can make good decisions at any given moment. Real yields, economic uncertainty, the high inflationary environment, interest rates leveling off or maybe even decreasing, but probably leveling off and staying elevated for a while. Money flows towards risk-off assets. And let's also not forget there's still about $1 trillion sitting on the sidelines waiting to be deployed. Political uncertainty, we've got a lot about that. Weakening DXY. Now remember, people, we've been very focused over the last 6 months or so that as the DXY went up, gold went down, vice versa. But that relationship isn't always that way. And so it's actually only 40% of the time correlated that way. So don't be surprised if we see moments where the dollar strengthens and metals strengthen with it. And then the last thing is money printing. I know I said there are 3 main takeaways, but I also want to put 2 wild cards on your radar. 1, the Fed's reverse repo market. Well, I can't go into great detail in this video. Right now, behind the scenes, the Fed is using the reverse repo market to suck up liquidity. This is something that I think we need to watch, as changes in that market, in my opinion, is likely to precede changes in Fed rate policies and to signal a desire or a need to inject liquidity back into the financial markets. So we should watch that. The second thing we need to watch as a wild card is this $1.7 trillion spending bill with over 4,000 pages that no one's basically read. We need to make sure that we understand what that is and what's the impact on it, because it doesn't mean that it's going to be inflationary, but it is possible. And so we need to learn more about that. Finally, I don't mean to throw shade at any professional analyst, right, or anyone out there making predictions, because folks that create models and use data in hopes of giving us a sense of what to expect from markets in the future, that's absolutely spectacular, and we truly appreciate that. But in reality, they aren't the problem. The problem is, what do we do with that information? We need to treat those assessments like snapshots or photos of a market as of today, understanding that this may not be the same assessment tomorrow because conditions have changed. As we continue to be bombarded with predictions for 2023, you as the investor, you need to make a good habit of putting these things in your rearview mirror and focusing ahead, focusing in front of you on the road and the conditions so that you can be responsive to the market and maximize your stacking efforts. Otherwise, we will get juiced again. Get it, like orange juice and the juice. All right, in the comment section, instead of price predictions, as it relates to prices of 2023, what one condition are you watching or you think will be most influential on prices? Or you can tell me, why do we like predictions so much? Or you can share a prediction for 2023 that you've heard that you thought was good, bad, or absurd. Either way, you're my A+ students for making it all the way through. Thank you very much. Always stack smarter and never stop learning.